You have got $9 trillion worth of European pension money sitting in US equities. And they are necessarily running for the doors, but definitely reconsidering their overweight. This is what I call the chart of truth. If you're sitting in Paris or in Amsterdam and you've been overweight US assets for the last 10, 15 years, this is a nightmare. You try parking $1 trillion of assets into European equity markets, even the big stuff, you're going to leave a mark. The US dollar is incredibly expensive, and it's not a great thing for the US for it to be. I do believe in diversification as its purest sense, and I do not believe that so much that is categorized as alternatives is diversification.
You're watching Excess Returns. I'm Matt Zeigler, joined today by the best squirrel since Slappy Squirrel from Animaniacs, which is a weighty compliment, if ever there was one. Mr. Blind Squirrel Macro founder himself. We'll find out by the end of this interview who's really found the nut here. Rupert Mitchell, welcome to Excess Returns, sir.
Thank you, Matt. I don't know what Animaniacs is.
I was going to say, did this ever make it? I am going to send you...
I grew up with American culture, but Animaniacs didn't make it to me.
I am going to ruin part of your day because the day is so young where you're talking to me from right now that it's still dark outside. And I can't wait to ruin part of your day with all the glory that was 90s Animaniacs, which is, oh, I'm so excited. This is great. We'll have you back on just to talk about Animaniacs.
I think you've just aged me. You just said 90s Animaniacs. I'd already started working in the 90s. I wasn't watching cartoons.
In my not very good defense, if I didn't have a younger brother, that experience of where you have somebody that's around you and you're like, wait, this is really, really good. And you get all the way sucked in.
All right. Well, everyone's talking about Bluey at the moment, right?
Exactly.
My kids are too old for Bluey, right? But everyone in your generation is talking about Bluey and saying it's amazing. And it comes from down here as well.
I know. You're exporting this to us. You got to get in on that. Tariff free. Come on. You got to do it.
Bluey and selling Afterpay to Square at the top of the market. Don't know which was the better deal.
Well, miscarriages all around. I'm sure they're embedded in all the deals and subcategories of shows. We're talking market stuff. Let's talk the sell in May professional humiliation. I think this was hysterical. I get this email from you the other day with the title of Sell in May, LOL. And I think that's part of because the best S&P return since you were backpacking in Peru in 1990, I believe. What the hell just happened? What happened to Sell in May? This isn't just Kramer. What's going on here?
Listen, I think everyone got completely freaked out. I mean, the professional investment community got freaked out by the policy uncertainty and the volatility in April and packed their bags and decided to go to beach for the summer early. And no one gave that memo to retail, who bought the dip like they have every other time in the past 2 years. And, you know, they're doing very, very well. They're back. They are so back, as they said. Meanwhile, everyone's sort of staring at this. It looked like it was going to be an all-time high today. I deliberately haven't switched on my my screens this morning so that we don't crash, but it looked like it was cruising towards another all-time high this morning or this evening. But yeah, we're so back, and it's that lovely cliche, a hated rally. No one's involved. You know, we're all going to be outperformed by our mums again this year. And, you know, as you say, there are two classes of investor that are loving life. Those that don't open their brokerage statement and the YOLO crowd.
So inside of this, does it mean retail was smart in any way, shape, or form? Or does it just mean the pros went on vacation early? Should we read into any of this at all? Or just know what needs to happen now that we've had this giant rally?
I mean, it's easy to be flippant about it, but, you know, this is career risk for everyone. And so these, you know, not only do you have the painful requirement to follow that is now hitting discretionary world, but our markets are dominated by machines. Now, you've had lots of smart people talking about the systematic influences in markets, so I'm not going to re-give that lecture. But with the combination of vol control funds, with the combination of, the trudge of 401k flows, that's just going to continue to drive the market higher. Now, the only thing that's running in the opposite direction is the chart of truth, right? And when you have got $9 trillion worth of European pension money sitting in US equities, and they are necessarily running for the doors, but definitely reconsidering their overweight, which has been the case for the last 5 years. The size of that European allocation into US equities is the same as the entire 401k and IRA sort of complex in the US, which you know so well. And if you support the view, which I do, that passive flows have been the primary driver of markets over the last 5 to 8 years, if not longer, then if you've got something of equivalent size, just dialing it back a bit. Now, I'm not talking about exodus. I'm not talking about freeing, but, if you look at this is what I call the chart of truth, which is just very simple in ETF terms. This is the SPY, the S&P 500, against the MSCI EAFE, which is the MSCI World Developed Markets ex-US. And it's been a one-way ticket for 12 years. And you've had people like me on the other side of the world sort of over-invested in US markets because it's been, the one market that's worked. And the best thing about it for us foreigners is that traditionally, when there was a wobble in markets, everyone rushed into US dollar cash. So our performance in euro, in Aussie dollars, in any other currency other than the greenback, we had this natural hedge. But, ever since the election, we've got a very different story. Now, that was the monthly chart. This is the daily chart, right? Are you buying or selling that, right?
And let's get all the value investors out here. They're all salivating. The rest of us are looking at this like a car accident.
Yeah, I mean, this is a chart that is clearly distributive now, right? And if you look at, you've had some fantastic technicians on your show, but I put on a couple of sort of fib retracement zones there, and we're holding the fib retracement of quote unquote Liberation Day. I don't know how anyone can say those words unironically these days, but we're sort of holding that fib. But we're just waiting for the next leg down, as far as I can see there. Now, I'm not talking about S&P 2000, right? I'm just talking about the steady outperformance of non-developed market, non-U.S. developed market equities relative to the S&P in dollars, right?
Can we talk just for one more moment about making this connection? You set up career risk in terms of retail versus pros. Then you sort of hinted at the career risk on, let's just call it pros on different sides of in the US versus out of the US, because this messes up a lot of US domestic managers. This is a hard reality of what this faces. What types of other career risk does this interject in the way people are?
Actually, the career risk is really for the pension fund managers in the rest of the world, right?
Explain.
So, I mean, ultimately, if your benchmark is some Vanguard target date fund, right? And you own 60 SPOOs or S&P all shares, and you're 40 in bonds, just like everyone else in the planning community. Well, you're kind of all right. You're in a warm bath of complacency because you know that everyone's doing exactly the same as you, right? And you might have got your clients into a sort of 2% gold allocation, which is giving you a nice little outperformance this year. But you're not too fussed about this chart. But if you're sitting in Paris or in Amsterdam and you've been overweight US assets for the last 10, 15 years, this is a nightmare. This is a nightmare. because that dollar hedge effect is working against you. It's compounding your underperformance. And so I think this is very real. And these allocators have to react to this chart now. So there is going to be a sort of self-fulfilling prophecy. And also, these guys are running into a much narrower door, right? You try parking $1 trillion of assets into European equity markets, even the big stuff, you're going to leave a mark. And that's your tail chasing away from you. So I really do think this thing has legs. Now, I've been involved in markets for over 30 years now. There have been cycles where international markets are favored over US markets. It's happened twice in my career, right? I'm just saying we might be going into one of those again. And I use the chart of truth somewhat tongue in cheek because it used to be referred to as a sort of the downward progression of 10-year yields by some. But this is my chart of truth.
There's something about pension funds with a hurdle rate where there's also a time aspect to this on the career risk side.
Yeah, absolutely.
How long do you think they have to start? I know we've seen a chunk of that allocation probably already. And like you said, that's going to leave a mark because if you're moving bigger dollars into smaller markets, this is what happens. But do you feel like there's also a budding amount of pressure for those professional allocators and those international pension funds to start to make these shifts sooner than later?
Yeah, because there's more influences going on, right? Because a lot of this, particularly pension fund money is, has to nod towards potential financial repression issues, right? I mean, ultimately, you're going to see regulators in Europe say, you know what? Being that dramatically underallocated to your domestic assets is a risk that you should not be taking. Now, they will couch it in risk management, but we're playing capital wars here now. You look at that. Look at that section 899 in the again inverted commas big beautiful bill, right? The same conversations are going on in Europe.
Let's jump over to the topic du jour on the left side of that chart when everything was running up before. I want to talk about the Mag 7.
Yeah.
Specifically, I have to point out, he referred to Nvidia as the Highlander because there can only be one dominant AI chip maker, and I'm all about.
It was. So there's a really funny guy on Twitter, Fusion PT Arun, right? He's one of the funniest guys on funniest meme lords on Twitter, and he was I think it was last March. He was sort of when we were ditching Tesla from the Mag 7, right? He was running down, and he what do we got next? And Fad 4, and I replied, well, obviously it's Thrilling 3, and then Dynamic Duo, and you have, I guess it's Satcher and Jensen fighting it out as to who's Robin. And then, of course, you have the Highlander, because there can only be one. And we had Jensen as the Highlander. I'm a bit disappointed it didn't go a bit more viral. It got picked up by a few people, but I thought the Highlander was perfect. There can be only one of the Mag 7.
I see it, and I just hear that I Am Immortal theme song in my head, and it's glorious. It's really glorious. I'm here for that. So Mag 7, and you had some crazy stat on the Mag 7 contribution to S&P 500 in May alone. What the hell is going on here? Talk me through what's sustainable and what's not.
I mean, 22% of the May contribution to the Mag 7 was the Highlander alone. This is not my bag at all. We can talk about what my bag is later, but this is, my estimation of 99% of all Robinhood accounts, right? This is what was an equal weighted portfolio time-stamped at the introduction of the futures-backed Bitcoin ETF 3 years ago, right? So you've got an equal weighted portfolio back then of Nvidia, the Highlander, Tesla, Palantir, MicroStrategy, and Bitcoin itself. And I was thinking back in April that if that near to 20% year-to-date drawdown didn't fix itself pretty quickly, we could have seen the end of the COVID launched era of retail option backed investment frenzy. The Cathy Wood era, if you like. But no, absolutely not. They carried on pressing straight out of those lows, and top to bottom to top, it's like 45%.
Yeah, that's a rally.
Those lows.
That's a rally.
That's a proper rally, and when it comprises two of the Mag 7 as well, right? That's we were talking about the career risk of European pension fund managers, but you've got, you're a planner. You must encounter people coming into your office going, I'm the daddy right now. I'm the captain of this ship right now. I know these markets.
To which I say, you're not the Tommy Tucker right now wearing your women's clothes and hawking your war bonds. I'm trying to give you a reference in the other direction. Tommy Tucker, you know that squirrel? No, it's an amazing chart. And I was shocked reading your newsletter when I saw that stat of whatever it was, 22% of S&P performance in May, just alone attributed to Nvidia. Because back to that point, this is another form of career risk for professional investors out there. And we definitely saw this in the run-up last year and the year before, where it was, I know it's a joke thing about.
It's 3 years in a row, right?
Right.
It's 3 years in a row of the pros having their asses handed to them, right? That calls into question a whole industry structure. Now, we all know how this ends, right? And we will just have to be tormented until it happens, right? What goes around comes around, right?
Let's talk about, what goes around comes back around again.
So perhaps we should talk about what I'm doing.
Well, I want to hit one other, and it's not so much an individual security thing, but then I want to hit the individual security because it was another point that I just hadn't seen anybody frame except for you, which was Apple. And this isn't a call on Apple, but let's just talk about Apple as the funding short and the way you frame this up, because I think this is also very telling.
Well, ultimately, I get that a lot of people have got massive unrealized gains on Apple stock sitting in, anyone that's owned that security, essentially, since Tim Cook turned it into an exercise in financial engineering, right, is sitting on ripe gains. No one wants to pay tax on those gains, but they're sitting on a security that's gone X growth, and which is trading at an eye-watering multiple relative to that growth. And it's a business that has failed to innovate since the AirPods, which I've given up on because I started to view them as a subscription service. $300 every time you lose something down the side of an airplane seat is just getting really unfunny. And you can buy these $30 ones off Amazon, right? I don't care if I lose 3 of those a month. So, I refer to it as the Cupertino rent seeker because, frankly, a lot of the moat that they've created around the App Store, it's not great for innovation and small businesses elsewhere. I publish my newsletter on Substack. We have resisted making subscriptions payable via Apple Pay because all of a sudden we'd all need to put up our prices by 30%. It's absurd. Anyway, I'm not a fan of the Apple. Was a fan, but it's I'd rather own its bonds frankly, than its equity.
Let's turn to what I think is one of the most interesting things that you're updating regularly, which is how you're actually investing your own money. I want to talk about the Bushy portfolio, fantastically named. And I think,
Well, I spent a bit of time in corporate equity derivatives when I was on the sell side. And, we love an acronym in the derivatives world. I don't know if you ever read Frank Portnoy's book Fiasco about the fixed income annual skeet competition. Fiasco, that was the name of the book. And that was the book. I spent several years in my career desperate to persuade my MD to pitch a permanent equity net interest swap. And so fun with acronyms always used to have. And so Bushy is the Blind Squirrel's ultimate strategic holdings with a bit of yield.
fit.
And there are some tail hedges too. Get it?
There are some tail hedges too. And I have to point this out because you nail it on all the important categories. You got the catchy name. You got the near pointless but very on point acronym. And then you actually have a thoughtfully constructed portfolio, which when did you introduce this? When did you start publishing this?
So so this really represents the way I've run my beta portfolio for years. Now we can do sex and violence elsewhere. I love talking single stocks and as much as the next person, but 75-80% is sitting in an always long type multi-asset portfolio. Now, importantly, this is a portfolio that has very few treasuries in it, right? This is an anti-60-40 portfolio, right? But I do have a bit of an allergy to long duration fixed income. Have done so for about, well, really since the Fed turned hawkish 3 years ago, and I just see really no upside to being further than a couple of years out in the treasury curve right now. I really don't. And I imagine it's a nightmare for people in your planning world because we've had 20-25 years of this inverse correlation between stocks and bonds that's worked incredibly well for US denominated savers. And turning that ship's going to take a lot longer than a couple of years. And there must be so many people in your industry going, it's going to turn around. It's going to start working again. I'm just going to turn it on and turn it off, turn it off and turn it on again a couple of times. But so the port for Bushy is categorically not 60-40. It has a bias towards a weaker US dollar over time. And we can talk about that very quickly. I'll just show you one chart quickly there. This is just, we're no longer in a world of your dollar, your problem. Well, it is your dollar, it is your problem.
Yeah.
But ultimately, just on a trade-weighted basis, the US dollar is incredibly expensive, and it's not a great thing for the US for it to be so expensive. This is one of the things that I think the administration is rightly targeting right now. But anyway, so Bushy has a weak dollar bias, right? We do own some bonds, but we own emerging market local currency fixed income, for example. We do occasionally happen to end up long treasuries, but only if the trend followers own them long. And right now, not many of them do. So we've got a 15% allocation to CTAs, to trend followers, pure. I mean, part of the reason behind that, Matt, is I regard myself as a terrible momentum investor. So I effectively have outsourced momentum to the guys that have no feelings, that just trade price. Actually, the trend followers are having a pretty tough time. Yeah, it's been the biggest drag on the portfolio. There have been two major drags on the portfolio so far year to date. One is the allocation to trend, which has probably been well, I can tell you exactly what it's been. It's been almost 105 basis point drag on total returns for the year. And the other drag on the portfolio has been the hedges against my core biases. So I had some currency options and some US tech equity options to hedge those underweights in the portfolio, and that's been 150 basis points of drag on the portfolio so far this year. But otherwise, it's a focus on international equities, and all these are all US listed ETFs right now, and that's the current positioning within that. Now, within that international equity allocation, I have something which I call international equity yield, and this is another characteristic of the portfolio. This is short duration, low volatility, high dividend yield, which usually coincides with low valuation. So there's a very, very strong short duration value bias to the portfolio, and it just takes the noise and the volatility out of it. Yeah, I have days when the K-Web, the Chinese tech stocks are up 5%, but and I've got a little bit of exposure to that via EMQQ, which is the emerging market triple Q. So there's a bit in there, but it's when EMs are moving, right, the iShares emerging market high dividend ETF is going to move 40% as much, right? And I'm okay with that. I mean, it just gives me a much more sleep at night sort of drawdown profile. And then themes. Everyone loves a narrative and loves the themes. And in there, you've got a bit of an energy bias. You've got some gold miners. There's a large precious metal allocation. I've got a 5% allocation to gold and to PMGs. Again via ETFs. Nothing scary or difficult to get your arms around. And this portfolio is up about 6.5% year to date. The drawdown profile, I benchmark it against the Vanguard 2035 target date fund. It's the 7.12 here on the chart needs to be adjusted down for the hedges that have cost me money. I talked about.
Yeah.
But Liberation Day was had us underwater for the first time in the year, but it was less than 10 days, right? And so, I mean, I look at these sort of it's ironic that we should be talking about the chart of truth when there's been a massive outperformance of dollar assets today, but my portfolio's had a decent day today as well. So I'm really pretty relaxed about that.
I feel like it's very important. And this is one of the things I know we've sent messages back and forth on this for a while now. Talking to people who are not just building other 60/40s. I've been doing this for some period of time. It's been in the back of my head probably since, 2016 or certainly the Grexit stuff, that if the deglobalization trend is on, then it's either alternative or something else. You got to be able to think about these portfolios differently, and you have to have a process. How much of this do you feel like is, and I'm not saying it's systematic, quantitative, emotionless process, but how much of this do you feel like is structured, in your words?
I read pretty much every paper that Cliff Asness ever writes, right? But do I do any back testing? Or am I running massive quant models of back testing? No. But I do believe in diversification as its purest sense, and I do not believe that so much that is categorized as alternatives is diversification. And I find the private credit and private equity bubble utterly terrifying right now. And listen, I'm not the only person sounding that alarm call right now, and let's not waste too much time talking about it. There are others that with much bigger bully pulpits than me that are doing a better job. But I think that I ironically refer to that whole complex as team saddlebags. Do you remember Tom Wolfe's book, The Man in Fiddle?
I do, yes.
That wonderful scene where Charlie Croker is being called in to have his loans called in, and they celebrate the fact when the sweat meets in the middle of his chest that they've achieved saddlebags. And so I've been calling the private asset complex team saddlebags for a couple of years now. There's a dedicated channel on my Discord to team saddlebags.
That's proving once again the respect of the squirrel Discord. Let's dive into beyond the portfolio itself and the construction, some of just the big themes, the big conviction stuff. I'm fascinated by this idea where everybody is talking about AI and crypto hype, yet you, and strangely enough, the commercials all through the Champions League final the other weekend. Goodyear tires everywhere right now. What the hell is going on with these tires?
Well, I had a crack at the tires, Matt, last year, and so this is a second bite at the cherry, right? I've got a bit of a fixation on low duration assets that we've already talked about. And sort of twinned with that is assets that are trading at a significant discount to their replacement costs. So I had a very successful but ultimate round trip in U.S. refining stocks last year. No one's gonna build another oil refinery in North America ever again. Yet, if you can own it a small fraction of what it would cost to replace, you've got a margin there. And guess what? We're going to be using refined products for the rest of our lifetimes for sure. Similarly, no one's going to build many more car tire factories right now. And if you think that a brand as iconic as Goodyear, in deeply nationalistic times is valued at $3 billion, I think you'd have a couple of come agains. But the beauty about the tire business is that they're pass-through businesses. It is costs plus a margin, right? And if you do as I do, feel that we're going to be entering into, I'm not talking about 1970s hyper. We're going to enter into a world of at least inflation volatility. And guess what? In the world of pricing, as soon as prices are spiked, they never come back down, right? It's just a high watermark, right? And then layer on, so you've got sort of a slightly sort of inflation proof, and because replacing bald tires is non-discretionary, I would argue, it's reasonably recession proof, and even more so.
You should try driving in the American South at some point. We'll put that to the test. But for most people, yes, you don't have a choice to drive on those bald tires.
Yeah, exactly. But the one of the problems that the US manufacturers like Goodyear were having was that there was a lot of cheap Asian imports. Well, let's call them what they are, Chinese imports, and some of the brands that you could have sworn were American are actually Chinese brands that are in the discount end of the market, and that was crimping the business for the big three, which is Bridgestone, Michelin, and Goodyear. And so these tariffs and the tariffs that relate to tires are definitely not on the list of those that are going to be questioned higher up and through the courts. This is part of the auto supply chain, the 232 tariffs. It's a massive leg up for an iconic American brand. And then there's the sort of longer term thesis. You know, the dirty little secret about electric vehicles is that, yeah, there may not be a tailpipe spewing emissions, but car tire particulates are a big emission, and a big polluter rather. And with the torque and the weight of EVs, you run through tires so much quicker. So there's a natural market growth angle, and then finally, you've got some of the thugs are in, right? So you've got a massive, you've got Elliott sitting on 10%. They are in the process of executing a major restructuring, which is called Goodyear Forward. And they have already completed the third of a three-part disposal strategy. They sold the off-the-road tire business. They sold the Dunlop brand. Did you ever have a pair of Green Flash, Dunlop Green Flash shoes?
Man, yeah, we had some Dunlops
They sold the Dunlop brand, and then they finally sold part of their chemicals business, their synthetic rubber business, and that was announced just at the end of May. And so they've raised over $2 billion of proceeds. And remember, this is only a $3 billion market cap. But yeah, there's a lot of leverage, but this is very well covered from an interest coverage standpoint. And I would actually say that leverage in this cycle, provided you can pay your interest bill, is a bit of a superpower. Right?
It's so interesting that, and this goes back to this is 5 years old at this point, but coming into this idea of a new roaring 20s, and I can't remember who coined it, if it was Christopher Lochhead or Scott Galloway or one of those types of people, and they said, the tangible 20s was one of the themes that came back on. And it was smaller scale, boring, and just kind of think obvious and tangible. And this tire framing, the way you're putting this together is such an interesting, forget the Goodyear aspect of it, but just this framing of we are full of these problems in the world right now.
Yeah.
Nobody's going to college to start an oil refiner. Nobody's going to college to start the next tire business. This makes for really interesting opportunities. Another one that I just want you to tick off because I think it's so fascinating.
The other thing, the important thing about this, the thesis here is that this business trades on 4.5 times EBITDA, right? For this deal to work, it can carry on trading at 4.5 times EBITDA forever.
Right.
Right. And there's no re-rating thesis in here.
Right. This isn't a value play where you say this has to re-rate higher from this to make sense to me.
No, just just holding this multiple against the cash flow stream that I see out 3 to 5 years, makes this a $30 stock.
We're going to go into generalist's edge and this whole idea in a second, but there's one other just story, because this doesn't just, Goodyear exists sort of in the US and as we think globally, but you also highlighted, and not to pick on it as an individual name, but the Korean utility you were writing about, just
listen, this is not a huge amount of original work. I spent a large part of my 20s spending 3 days a week in Seoul. Right, and one of my bigger clients up there was Korea Electric Power, KEPCO, and my good friend Eric Renanda, who writes a fantastic Substack called Your Weekend Reading, and he's a real dude. He used to be an analyst at a Passport at Burbank's fund on the West Coast, and he is quite quanty and runs a number of sort of factor screens, which I, always find something interesting, because they'll be sort of like, oh my word, there's a Taiwanese chemicals company or a Malaysian shipbuilder that's sort of kicking out of his factor screens, and it's great fodder for inquiring minds to dig deeper. And his screening model came out the other day and said, and pointed out that KEPCO was trading at 2.5 times earnings. Right.
That's a low multiple, I think.
that is a low multiple. That is a margin for error, right? In a market that I kind of want to own a bit more of in Korea, right? So that is fire first and ask questions later.
Well, on the theme of shoot first, ask never, let's talk about being a generalist, because I don't think you stumble into stuff unless you have this approach of being a generalist, not being cornered off into this is the only way to do things. Talk about how your curiosity chases all these nuts here.
Well, I think silos are really dangerous, right? If you are hyper specialized, you one in danger of not seeing the wood from the trees, and I think coming into any situation with a fresh pair of eyes is really valuable. Now, I feel very fortunate in that I was, at the point of my sort of my career when I had the most malleable mind. I was in a convertible bond business, right? And the wonderful thing about that product is that it's a bit of rates, it's a bit of credit, it's a bit of equities, and it's a bit of derivatives. So it turns you into a bit of a Swiss Army knife of a practitioner. And so, it gives me the confidence to kind of look at anything. I'll look at a credit trade. I'll look at an FX derivative, and I'll get into the weeds of I'll build a DCF on a value stock. I'm really happy to hop between those various opportunities. And the world's got a lot of specialists, and I have huge amounts of time and always plumb their knowledge. But I want the ability and the flexibility to go where the action is, or where I think the action might be, I should say.
How do you learn to do that, or is that just a natural career progression?
I just read constantly, and it is, the thing about what we do is that you're never really done. There is always something else to watch. There is always another paper to read. There is always, a new topic to research. Now, listen, I can be quite rude about AI from time to time, and there's an awful lot of AI generated garbage and slop on the internet. But as a research or a support tool, things like Perplexity and Notebook LM are just incredible, and we can just cover amazing amounts of ground using those, and so it's become even easier to be a generalist.
Even easier with, I'm experiencing this. It's almost more fun with some of these tools. Something that was already fun is now almost even more fun because the Perplexity search or whatever the layer is.
Oh yeah, it's trying to with old sort of analog search, just fighting your way through the crap to find the McKinsey report on the topic that you were looking for, or whatever it was. It's just so time consuming. Now you can tell the AI precisely what you're looking for. Go and prepare a reading list for me.
Right.
Yeah.
I think far too often about just the progression of going from, physical book to document and, oh my God, Control F. And now to be able to say, like, I need 5 things that capture the theme inside of this, and I'm only going to keep 3. So maybe give me 10, but then we're going to cull from there and you're going to send me for other sources.
So I was reminiscing about being a junior corporate finance banker in the early 90s, and we used to just preparing a sheet of comparable company multiples was a week-long task of all-nighters, right? It involved going to a physical corporate finance library to get historical filings and broker research notes on 10 companies, and then manually data entry, into 15 tab Lotus 1, 2, 3 spreadsheets, right? And it was, and you'd be looking through the accounting notes to check that you were applying EBITDA consistently across the various companies in various jurisdictions, etc. That's a 2-minute task on Koefin to bit. But if your life started when preparing a comps table was a 2-minute task, do you know how to look at a balance sheet? Do you understand? Do you understand how an income statement's really working? Probably not.
That ability to,
So do worry about shortcuts.
yeah, that ability to still be able to build the things becomes an important part of this puzzle. All right, let's have a little fun. Though we're gonna ask you some closing questions here. Anything, and feel free if you want to pull up a slide or anything on this, just pull them up. But if not, no big deal either. Anything that you think everyone thinks is going to happen in 2025 that won't?
Whatever happened last time, right?
Well said.
That is, it's credit's just too obvious, right? It's not going to be credit.
Right. Everyone is officially talking about it now. So then how can it be that?
Listen, don't get me wrong. I've got a credit hedge on, but it's one that's not, it's not got a painful negative carry cost associated with it, but it's never going to be the same thing. It's never going to be the last lightning strike.
What about, is there anything you think nobody's talking about that more people should be talking about? Or is it just finding some of the odd stuff that you're stumbling across in your extensive reading here?
Maybe it's just me, and maybe it's just a bias thing, but I am getting the sense that there's a sort of groundswell of hostility brewing towards what I call sort of BS accounting, adjusted EBITDAs, and the sort of the fact that there's almost no similarity between GAAP numbers and what companies are talking about in their quarterly calls. And I'm just sensing that everyone's kind of sick to death of it now. And I maybe this is wishful thinking, but that's my thing that I think people might be seeing on the front page of the Wall Street Journal at some point later this year.
Investment banker hat, do the right people actually care about that problem? Or is this something that's fun to philosophically debate?
I think we're in an environment when, people always start asking questions when something breaks, right? Now, if we are, we've new all-time highs today. If we are talking about S&P 7,000 at the end of the year, no one's going to have this conversation. But if we do see a shift in markets away from what we've been experiencing for the last 3 years, and people start to lose money in equities because actually they shouldn't have been buying something on 12 times adjusted EBITDA, which is actually 42 times GAAP EBITDA, right? At that point, people go, yeah, we should be talking about this more.
What about any big contrarian calls for year end? We got half a year left. Give me something contrarian and fun.
One of the hyperscalers breaks ranks and says, all this AI capex is bullshit.
Just straight calls it bullshit. That's where we're going. Like not even
No, I've got a hunch. Who could do it, right? Now, I'm no fan of the business in terms of what it's done to the world, but Meta could do it, right? They do not, AI is already good enough for them to help them target ads. They don't need to be playing in the arms race with Llama, right? They're saying, yeah, we're good here. This thing's already doing what it's useful for us, and you do you, right?
If Meta becomes the savior and we're not all wearing Oculus headsets, there might be multiple wins inside of that playing out. Let's ask some of our favorite closing questions on the show. I got 2 for you today. What's one thing that that you wish you could teach the average investor?
JOMO. The joy of missing out, right? The expected value of being late to any trade is truly terrible. And the sooner that you realize that, something cool has happened. Yep, it moved. It's up 20%. The sooner you realize that you can just smile and watch it, the happier and hopefully the wealthier you will be. But it's a really tough one, right? We're all programmed to chase, right? But you've just got to sit back and just enjoy that missing out.
I like to think about that as they're fireworks, right? You don't want to touch that. You don't want to touch it. You can sit back and you can watch it and be cool with it.
Yeah, absolutely. You do you.
What's one thing you believe that you think the majority of your peers would disagree with?
I think there's a real tendency to try and emulate famous traders and investors, trying too much to be the new Druck or the new Warren Buffett. I don't think that they would try to be themselves second time round. So, by all means, read your market wizards, understand what they do, take little snippets or, I hadn't thought of that, or whatever from these, these investment geniuses of the past. But you've got to craft your own channel, right? There's no right answer, and the only right answer is the one that's right for your personality, because it's the enemy within that needs to be conquered.
Well, here's to the heroine's journey and not just the hero's journey on that topic. I'm going to put it out there, Rupert. I love the stuff you're doing. I love all the Blind Squirrel stuff. I'm a subscriber. That's why you're here, because I think there's just so many good ideas. If people want to learn more, they want to follow more, connect with you on the internet, where should they go?
So it's really easy, blindsquirrelmacro.com. I write a couple of times a week. There's a podcast that comes with that, which is really just an audio version of one of the weekly letters. As we talked about, I run a model portfolio, which is Bushy, which a lot of people, which basically came into existence by popular request from readers. And you can find me on Twitter, Squirrel Macro. I'm on the other social apps as well, but don't spend very much time on any of them these days. But my readers and subscribers also have access to my Discord server, the Dre, which is where I'm spending most of my time now. And we've got plenty of lurkers in there, but we've got lots of quite active contributors, lots of smart people in there, lots of fun ideas, and lots of fun debate, and super friendly and not remotely sort of toxic.
If you can keep enough of the toxic people out and enough of the good people in, I admire greatly what you're doing in building this community. And I just love that we have non-traditional practitioners who are operating at a very high level who have a background in thinking about this stuff. So Rupert, I'm so excited to finally get you on Excess Returns. Thanks for joining me today.
Matt, thank you.
Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on YouTube or your favorite podcast platform, or leave a review or a comment. We appreciate it.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the participants or their clients.